approach 2024 and 2025, forward PE are rising again, now near the 31 times earning. At the same time, the ROE climbs to roughly 37%. On the surface, this looks justified, but there is a catch. And this is where investors get complacent. ROE growth has flattened, right? Do you see that? Do you see the blue line flatten? Do you see the green line straight up? ROE has flattened. Valuation, however, have reignited. So, this means the market is once again paying more for the same level of profitability. So if ROE stalls while multiple stays high, returns suffer. If ROE falls while multiples compress, losses will accelerate. This is no scenario where valuation, doesn't matter. So this is not a bearish chart. It's disciplinary. It does not say sell everything. It says be precise. The last 30 years, tells us one lesson over and over again. Growth investing works best when profitability leads valuation, not the other way around. Ignore that and you repeat 1999. Respect it and you survive what comes next. The market always forgives bad narratives. It never forgives bad pricing. Remember that. And that's why this chart is extremely important. As we are getting higher and higher in terms of, the idea that valuation is getting pricier, you need to realize this chart shows you that basically, the blue line might be, flat, but the green line is getting ahead of itself. And that is always a potential. This is a 30-plus year record of capital miscalculation. A slow-motion distortion on how market price risk, growth, and reality itself. What you're seeing here is the price-to-book ratio of value stocks relative to growth stocks inside the Russell 2000, the Russell 1000. And the message is brutal. Value has been systematically repriced lower for more than 2 decades. Not because fundamentals collapsed, but because policy, liquidity, and narrative crushed it. This is a chart of an era. From 1990 to 2024 is the price to book.
The only thing better than a Red Robin Tavern Burger is a Red Robin Tavern Burger with a bottomless side and beverage for less than $10. Holy hamburgers, they did it! Get a taste of burger obsession with the Big Yum Burger Deal for just $9.99.
Red Robin Yum.
Meaning how much you're paying for the price of a stock versus the book value of the stock. And obviously, it's getting crushed. Meaning we're willing to spend more and more and more beyond the value, the book value of the stock. So let's define the axis. When the ratio is high, value stocks are expensive relative to growth. When it is low, value stocks are cheap relative to growth. In the early 1990s, this ratio sat comfortably around 0.4 and 0.5, as you could see. now it is changing. The early 90s, the ratio is at 0.4, 0.5. Now, then comes the late 90s, the tech boom, right? And you could see that the ratio collapsed as growth was bid into the stratosphere. And the value was left behind. And the dot-com crash, something important happened here. Value didn't just recover, it overshoot. By the early 2000s, the ratio surged to 0.6, a full reversion plus excess. This was the last time valuation discipline truly mattered. Now, focus on what happens next. For roughly 2004 onward, the charts begin a persistent downward sloping channel. Not cyclical, not noisy, not random, a structural decline. Every rally in value is weaker. Every peak is lower. Every recovery fails faster. This is not a market accident. This is a result of zero interest rate policy, quantitative easing, asset price targeting, suppression of discount rates, and the finalization of narratives. When capital is free, duration wins. When rates are suppressed, future promises dominate present assets. When central bank remove downside, speculation replaces valuation. I mean, what's going on right now with the Fed? I mean, they just basically saying, game on. We are going to keep rates low. We are going to keep the dollar weak. We are going to keep repaying the debt by refinancing. We are going to keep the party going. Growth stocks became bond proxies, infinite duration assets in a world where discount rates were engineered towards zero. And value stocks, like banks, energy, materials, and industrials were treated like obsolete relics. A bank? Who wants to invest in that? And then the reason price to book matters, right? Why does it matter so much? Well, book value represents tangible capital, accumulated profits, infrastructures, and real assets. So when the price to book collapses, you are paying almost nothing for replacement cost. You are ignoring the balance sheets. You are assuming assets never matter again, and the assumption that only being true under one condition: artificially low interest rate. The chart is effectively a shadow yield curve. As rates fall, growth is being bid up. As liquidity expanded, valuation discipline evaporated. And the market learned one dangerous lesson. You don't need cash flow, you just need a story. Today, security analysis is about telling us stories. What's going on? For example, what's a story about Tesla? What Tesla is going to make robots? Tesla is an AI company. Wow, okay, let's pay 150 times P ratio for Tesla. Does this make any sense? Central banks stepped in as permanent buyers of duration. Risk premium was compressed. Volatility was suppressed. Capital was herded into the same narrow trades and mega cap growth. Platform monopolies, intangibles, heavy balance sheet. By the late 2010, as you could see, the ratio was approaching 0.25. That means growth stocks were trading 4 times the price to book multiple of value, and markets treated as normal. This is not normal. This is policy autocraft. Then came 2020. Remember 2020? Zero rates, unlimited QE, fiscal dominance. The ratio collapsed, historic lows of 0.2. No one cares about the book value. Speculation exploded. Meme stock, unprofitable tech, narrative investing. Anything tangible was dismissed as old economy. But notice something critical. Even during the 2022 inflation shock, when rates spiked, Value never regained its former relative valuation. The bounce was weak. The trend line held. This tells you something unsettling. Markets are still pricing growth as structurally superior even in a high rate world. That belief is fragile. So this is not a backward looking, this is a warning. Okay? Because price to book compression of this magnitude historically ends in one or two ways. One, a violent re-rating of value upward, and two, a prolonged destruction of growth multiples. Either way, the status quo does not persist forever. You cannot indefinitely price productive assets below replacement cost while pricing distant cash flows as if risk does not exist. If rates stay higher for longer, if capital becomes scarce, if earnings matter again, this ratio does not drift lower, it snaps. And when it snaps, it doesn't move politely. This chart is the autopsy of the last monetary regime. It tells you exactly how you got here. Cheap money, narrative dominance, and the abandonment of valuation discipline. But it also hints at what comes next. Because the most hated asset class in a distorted system is usually the one that survives a reset. Think banks, think utilities. Values hasn't disappeared, it has been suppressed. And suppression always ends the same way. Not with a smooth adjustment, but with a reckoning. Watch this ratio, because when it finally turns, it won't be a trade, it will be a regime change. If you take a look at this, it tells a story Wall Street does not want retail investors to fully understand. What you're looking at is not price levels, not headlines, not a hype. This chart measures every major bull market since the 50s. Right? All indexed at 100 at the start, and then track day by day to see how they compare. Same start line, same benchmark, same rules. And right now, the red line is at the bottom, and that's us. That's us right now. Okay, October 2022 to today, because that's basically since that's when this bull market started. So the question is not whether markets go up over time. The question is, what kind of bull market are we actually in? And most importantly, how does it end? So first, let's be precise. This chart measures two things simultaneously. Length, how long a bull market lasts. And two, strength, how much total return it delivers over time. Every lines begin at 100, okay? So we're measuring all of them separately. Even move higher, every move higher is basically a cumulative gain. No dividend reinvestment tricks, no leverage, no survivor bias, none of that stuff. So just raw material. And that is important. So what are we looking at? Well, basically, bull markets are not created equal. Some burn out hot and die young. Some grind higher for years. Some deliver massive upside and then give it all back. History does not rhyme neatly here. So let's talk about the famous one. Look at the 1982 to 1987. A monster rally of inflation crushed valuation. You see that one? So And then look at the 1990 to 2000. The tech bubble, explosive gains, parabolic acceleration. Look at the 2009 to 2020. It's the post-GZG.
That feeling you get when you're getting an incredible deal. When you're spending less and getting more. When every aisle offers quality items at the best prices. That feeling of value. That's why you shop Ocean State Job Lot. Shop your local Ocean State Job Lot for all the things you need. Here, you'll always find a lot more for a lot less.
Your home sweet home just got even sweeter because Hobby Lobby has hundreds of exclusive decor items for every room in your house. Ready to refresh or even redecorate? Shop in store or online at hobbylobby.com.
If you see bull market, the one lasted 11 years. And that's the one post the great financial crisis. And notice something critical. The longest bull markets are not the steepest early on. They start quietly, they look boring, they feel underwhelming until they don't. And that's my point all along, is the least you hear about it, the better off you're going to be. The more people say, oh, the market is going up, the market is going great, nothing could go wrong, you worry about that. But when they don't talk about it, when they say, oh, we're overvalued, which is kind of what we're saying right now, then you're kind of safe for the time being. The most dangerous bull markets are not the one people stop questioning. The most dangerous bull markets are the ones people stop questioning. That is something that I tell my subscribers all the time, and my Patreon members as well. Watch when they don't talk about the risk anymore. So now let's talk about this cycle. The red line. October 2022 onward. So what's striking is not how high it is. What's striking is how fast confidence returned. The bull market did not emerge from a banking system collapse, mass bankruptcies, forced deleveraging, system balance sheet repair. It emerged from the fastest hike in 40 years, the most inverted yield curve since VOCA. Persistent inflation above target, exploding federal deficit, and a Fed that paused but never actually loosened. That is historically unusual. Past bull markets were born from relief. This one was born from denial. That's the interesting part about that. So next, here's where this chart becomes uncomfortable. Notice where most bull markets started. They began at low valuation. 1974, 1982, 2009. Markets were cheap. Risk was hated. Cash was king, as you remember. But October 2022, valuation never truly reset it. PE remains elevated. Profit margins stayed historically stretched, and mega cap concentration increased. This bull market did not start from ashes. It started from hope that nothing would break. That's a different kind of foundation here. We're already high, we want to go higher. So now look carefully how smooth some of those past lines are. Broad participation, multiple sectors contributing. Now compare that to this cycle. Handful of names, driving index level returns, right? AI, mega cap, passive flows. So when bull markets are narrow, they don't collapse immediately. They thin out first. This chart doesn't show that it directly. The history does. This is very different, right? You're focusing on a few stocks, on a few industries now. And of course, the most important takeaway is this. Bull markets do not die of old age. They die from policy errors, liquidity shocks or earnings reality checks. And the longer they run without fundamental repair, the more violent the adjustment becomes. Every line on this chart ends the same way, with a drawdown that investors said would not happen this time. So when you look at this chart, don't ask, how high can it go? Ask, what assumptions does this bull market require? What breaks those assumptions? And who is positioned for that moment? Because history does not repeat, but market always overestimate the permanence, and this chart is a proof. Tesla. But let's be clear from the start. This is not about Tesla, the company. It's not about Elon Musk tweets. It's not about EV deliveries next quarters. It's not about price targets from sell-side analysts. This chart is about market structure. And if you understand what this chart is showing you, you understand something most investors still do not, because Tesla is not trading randomly. Tesla is not trading emotionally. Tesla is trading in cycles. And those cycles are visible, measurable, and repeating. Let's walk through exactly what the market is signaling and why the next move could be far larger than most people expect. So this is a weekly chart, not daily, not intraday, not 5-minute noise. Weekly charts stripped away emotion. They strip away headlines, and they show institutional behavior. Pension funds, sovereign wealth funds, endowments, long duration capital. People that are in it for the long haul. Weekly charts are where real money leaves footprints. And this weekly Tesla chart is going to show you footprints that are unmistakable. Look closely at what Tesla has done repeatedly. You see it here and here, you see it here and here and here. Look what's happening, right? Large rounded bases. Extended period of consolidation, then sharp, violent breakouts. Obviously, this is not random, right? This is a classic accumulation behavior. Institutions do not chase price. They accumulate during boredom. They buy when retail the people like you loses interest, and they buy when volatility collapses. And then when supply is exhausted, price explodes. This is exactly what this chart is showing you. And it's a great chart if you think about it. Now let's talk about the horizontal line. These are not trend lines. They are not moving averages. They are market memory levels. Every major breakout in Tesla begins the same way. First, you build a base. You test resistance repeatedly. And you finally breaks above it and never looks back. Look at the first base, breakout. Measured, move higher. Look at the second base, breakout. Measure, moves higher. Look at the third base, breakout, measured, move higher. This is textbook price discovery. And price discovery is where valuation stops mattering. Now focus on the right side of the chart. Tesla spent months, not days, not weeks, months building a base, right? A deep rounded structure, multiple failed breakdown, strong downside rejection. That tells you something critical. Sellers are exhausted. If sellers had control, prices would not stabilize. It would cascade lower. Instead, price held. Volatility compressed. Volume dried up. This is accumulation. And then the breakout. Now let's address the number everyone is focused on, 520. This is not random upside target. This is not wishful thinking. What is that? This is a measured move. Market moves in symmetry. When price breaks out of a base, the most common move is base depth, added to the breakout level. This is exactly what this chart is illustrating. Same math, same structure, same behavior. And then the market has already confirmed the breakout. So why is Tesla a liquidity stock? Here's the best part. This is a part most investors miss. Tesla is not trading purely on fundamentals. Tesla is trading as a liquidity proxy. When liquidity expands, Tesla outperforms. Tesla leads. Tesla overshoots. When liquidity contracts, Tesla underperforms. Tesla corrects violently. Tesla resets expectation. This is not opinion. This is not an opinion. This is observable. Tesla is long duration, high beta, narrative driven, momentum sensitive. That makes it extremely responsive to financial conditions. So what does this matter micro-wise, right? Well, we're in a market environment where rate cuts are being discussed, liquidity expectations are shifting, and risk appetite is creeping back. Markets do not wait for rate cuts. Markets front-run liquidity. Tesla is telling you that risk appetite is returning, not everywhere, not evenly, but in high beta leadership stocks. This is when people get destroyed. This is Tesla at 400 plus. They say, oh, it's too late, it's already run. That thinking is exactly why institutions wins all the time. Breakouts are not tops. Breakouts are beginnings. Most of Tesla historical gains has happened after it felt expensive, after it broke resistance, after skepticism peaked. Price do not move because it is cheap. Price moves because supply disappears. So notice something else. Volatility collapsed during the base. Weekly ranges tightened, right? This is not a weakness. This is energy being stored. Markets move from compression to expansion. The chart is transitioning into expansion. So why this is not a straight line? Well, let's be realistic. Tesla will not go straight to 520. There will be pullback, shakeouts, false breakout and all that. But ultimately, looks like the next move is up. Take a look at the recent, maybe it's time to put on some short-dated call options. Now, what would invalidate this setup? Well, this is critical. Every thesis needs invalidation. Well, this could set up if Tesla loses the breakout level decisively, weekly closes fall back into the base, momentum completely unwinds, and absent that, the trend is intact. So why this Tesla matters beyond Tesla? Tesla is not just Tesla. Tesla is a signal. When Tesla breaks out, growth sentiment improves, risk curves steepen, capital rotates towards momentum. Watch what happens next with semiconductors, AI infrastructure, high beta tech. Tesla often leads, not follows.
Choosing a high-yield saving account is just like plating an exquisite dish. I want to make sure that I have the key financial ingredients to support my well-being. Marcus offers a higher interest rate than traditional banks, so my money isn't just sitting idle, it's growing.
For an elf, the holidays are stressful, but Verizon's got a bonkers deal on the new Samsung Galaxy S25. Get Gemini, when's our next train coming?
Right now.
Ah, nutcrackers. Gemini, where am I?
You're in a blender.
Okay. Time for elf care. Gemini, find me a massage, please. Oh, that was fast.
Get Samsung Galaxy S25 with Gemini and Watch and Tap, all for $0. No trade-in needed on any plan.
let's start with a chart that Wall Street is desperately hopes you ignore. This is not a sentiment. This is not a vibe check. This is not a short-term trading signal. This is math. What you're looking is you're looking at the S&P 500 PE ratio plotted against a subsequent 10-year annualized return. That is what you're looking at. And the message of this chart is brutal. The higher you pay today, the less you earn tomorrow. No narratives, no Fed spin, no hype, no AI hype, none of that. As you could see, as you go forward through time, the higher the PE, as you could see, the lower the valuation. The forward PE and the amount of return. The more the PE, the lower the return. The more you're willing to pay for it, the lower the return. So on the horizontal axis, this is very good. We have the forward price. We have the forward price to earning ratio, which is how much money investors are willing to pay for each dollar of earning from a particular company. What investors are willing to pay for expected earnings at a given moment in history. And on the vertical axis, we have what investors actually earned over the next 10 years, annualized. So each dot represents a historical starting point. And notice the pattern. As valuation rises, meaning as the more you pay for it, PE ratio of 0 to, a lot, in this case up to 24, 25, that's an average, obviously. Keep in mind that, for example, Tesla is 150 for PE. Anyway, notice the pattern. As valuations rise, returns collapse. This is not subtle. This is not debatable. The regression line slopes decisively downward. This means nearly 3/4 of long-term return outcomes are explained by starting valuation alone. Not earning surprises, not innovation cycles, no central bank errors, valuation. The further you go to the right, which means the more you're willing to pay in terms of a PE, the lower the amount of return over 10 years, as you could see on the left. This thing is hedging towards bottom right. This matters because forward PE already assumes earning growth, margin stability, optimistic forecast. In other words, this chart is already generous. And even with that generosity, the outcome is clear. When investors paid 12 to 14 times forward earnings, 10-year returns clustered around 12 to 18% annually. When they paid more, which means 16 to 18 times forward earnings, return fell by 6 to 10%. And when investors paid 20 to 24 forward earnings, return approached 0. And in some cases, negatives. So that's not a crash. That's worth. That's a lost decade because it's a 10-year. It's a 10-year forward earnings. So where are we today? Well, that's where the part nobody wants you to talk about. Look at the far right of the chart. That's us. Look at all the way to the right. At the bottom, you see that? Estimated earning P ratio for December 2025. That's us. That's where we are.
Your membership is more than just a card. It's your gateway to extraordinary experiences. With the AAA app, discover savings and hidden gems. AAA, we're always with you.
That feeling you get when you're getting an incredible deal. That feeling of value. That's why you shop Ocean State Job Lot. Here, you'll always find a lot more for a lot less.
So this places us in the historical danger zone. Based on this relationship, expected 10-year returns fall somewhere between 0 and 3% annually, before inflation, before taxes, before volatility. This is not bearish ideology. This is arithmetic. You can debate timing. You cannot debate valuation math. Now, let's address the usual pushback. Yeah, but this time is different. It's never different. Rates were lower. Rates were also low in the late 60s. Returns were awful. Technology changes everything. Well, so it did in 2000. AI justifies higher multiples. Well, AI does not repeal cash flow discounting. Every generation invents a story to justify paying too much. We are on our way for something. When it's going to hit, that is going to be the question. Every generation learns the same lesson. Valuation don't determine when markets fall. They determine how much return you give up while you're waiting. That's the trap. This is not a collapse. This is underperformance. This chart exposes the real danger facing investors today. Not a crash headline, not a panic sell-off, but a decade where stocks go sideways, volatility increases, real returns evaporate, and investors stay fully invested because nothing seems wrong. That is how capital quietly destroyed. That is how it gets destroyed. Not violently, gradually. You're looking for the crash. No. And here's a takeaway. High valuation don't tell you what to sell. They don't tell you when to sell. They tell you what not to expect. And right now, the market is priced for perfection, stability, and permanent optimism. History says that price leads to disappointment. Every time. The question isn't whether this chart is right. The question is whether investors are willing to accept what it's telling them. Because valuation always wins. Not today, not tomorrow, but over the long horizon, that actually matters. So keep that in mind while you're looking at this chart, looking how much people are willing to pay, investors are willing to pay for stocks. And as you could see, the higher they pay on the right, the lower the returns on the left. Which means for you to make money, what you need to do, you need to be on the left side. You need to invest in low PE stocks, but not the Walmart of today. You want to invest in the Tesla or the Nvidia of tomorrow while the PE ratio is still low. And that is the secret. Here's another one for you. Let's take a look at this chart very carefully. This is not just growth versus value. This chart is a structural warning about how distorted the U.S. equity market has become and what it means for investors going forward. When you are looking at is the S&P 500 growth versus the S&P 500 values. expressed as a percentage of the total S&P stock price index, going all the way to 1990. So blue is growth, red is value. And the horizontal line is a 50% represents the balance. And right now, growth is sitting at roughly 73% of the entire S&P 500, while value has collapsed at just 30%. That's not normal. That's not healthy, right? And historically, it never ends quietly. So let's start with the big picture. For most of the modern market history, growth and value believe it or not, around parity. Sometimes growth leads, sometimes value leads, but they revert toward balance, right? Markets like symmetry. Look at the chart. Look at the old chart. At one point, there was symmetry, right? If you look at the chart itself, this is from 2026, right? So basically, when you were in 2008, 2000, there was symmetry here going on. But not any longer. Why? That symmetry is lost. What does it mean? Well, sometimes growth leads, sometimes value leads, but they revert toward balance. When one style becomes too dominant, it carries the seeds of its own reversal. And every single time growth has pushed this far ahead, every time it has been followed by painful underperformance. Go back to the 90s. Look at it. Go back to the 90s. Look at that spike in blue. Okay? That was the dot-com era, when investors convinced themselves valuation no longer mattered. Growth exploded, value collapsed. Old economy companies were treated like relics. And what happens next? Well, the NASDAQ crashed nearly 80%. Growth imploded. Value survived. Right? And then outperformed for nearly a decade. This chart didn't just flash a warning back then. It screamed, look at it. It's talking to you. It is screamed. Fast forward to today. We are now well beyond, that dot-com extreme. Growth doesn't just dominate. It completely controls the index. Look at the blue line to the right. The S&P is no longer a diversified market bench.
At Red Robin, we're making burgers better than ever. And right now, we're serving up an unbeatable deal. Introducing the $9.99 Big Yum Burger Deal. Not $10, $9.99. That gets you Red's Double Tavern Burger with 2 perfectly smashed patties plus a bottomless side and beverage, still under $10. And you know what? We'll even throw in the napkins. Get a taste of burger obsession with the Big Yum Burger Deal for just $9.99, not $10.
Red Robin. Yum.
Discover a stunning selection of faux flowers in Hobby Lobby's floral department. Whether your specialty is bouquets, fairy gardens, centerpieces, terrariums, or wreaths, you'll find everything you need to create something beautiful.
Mark? It's not. It is concentrated growth trade masquerading as diversification. A handful of mega cap tech and AI linked stocks now dictate index returns, volatility, and risk. This is not capitalism allocating capital efficiently. This is crowded positioning amplified by passive flows. Let's talk about what changed structurally. First, ultra-low interest rates. For more than a decade, the Federal Reserve trained investors to believe that duration is free. Future earnings were discounted at near zero rate, which massively inflated the valuation of growth assets. When rates are artificially suppressed, long-duration assets growth stock look irresistible. A value which depends on current cash flows gets ignored. Second, passive investing. ETF don't ask questions. They don't evaluate valuation. They buy whatever has the largest market cap. So when growth starts outperforming, it attracts more passive inflows, which pushes price higher, which increases index weight, which attracts even more capital. That is not price discovery. That is momentum compounding. Third, narrative dominance. AI, cloud, platforms, winner takes all. These narratives convince investors that scale alone guarantees future profits, regardless of the price. And then narratives dominate fundamentals. Valuation stops acting as a constraint until suddenly it does. Now, here's the most important part. This chart is not saying growth stocks will disappear. It is saying expectations have become mathematically unsustainable. When growth is already 73% of the index, there are now two ways around. Either growth continues to absorb an even larger share of the total market value, which would imply absurd concentration, or returns compresses. Historically, it's always the second option. Let's bring in the macro overlay. Interest rates are no longer zero. Liquidity is no longer unlimited. Fiscal dominance is crowding out private capital. So long duration assets are no longer being subsidized by policy. That changes the discount rate regime. And when discount rates rise, even modestly, growth evaluation are hit first and the hardest. Value doesn't need perfection, growth does. Look at the shaded recession band on this chart. Every time the economy slows, growth dominant gets tested. Why? Because in downturns, investors rediscover cash flow, balance sheet, and pricing power. They stop paying attention for stories and start paying for survival. That is when value quietly regains relevance. Now, zooming in the last 5 years, even though inflation, rate hikes, banking stress, and growth dominant kept expanding, that tells you something critical. This isn't confidence. This is dependence. The entire market has become dependent on a narrow slice of growth stocks to keep indices afloat, those Magnificent Seven. This is not resilience, it's fragility. Here is the uncomfortable truth. When growth eventually corrects, it doesn't need a crash. It only needs time. Fiat returns combined with inflation quietly destroys purchasing power. Meanwhile, value doesn't need heroics. It just needs normalization. Reversions don't announce themselves. They grind. So what does this mean for investors? It means diversification based on tickers is meaningless if exposures are identical. Owning 5 S&P ETF is not diversification. If they are all loaded with the same growth risk, it means the next decade is unlikely to look like the last one. And it means the biggest mistake investor can make is assuming that we worked during the era of zero rates will continue to work in a world of structural constraint. This chart is not calling a top tomorrow. It's calling out imbalance. Markets don't break because of bad news. They break because of crowding. And right now, growth is not crowded. It is dominated to an extreme never sustained in history. So the takeaway is simple, right? When one style becomes this large, future returns are mathematically pulled forward. What feels safe becomes risky. What feels boring becomes valuable again. And history suggests that when growth commands this much of the market, the next chapter is not acceleration, it's adjustment. So if you understand this chart, you understand why forward returns matter more than backward narratives. This is not about timing. Again, it's about recognizing that imbalances always resolve. And when they do, they rarely reward the most crowded trade. Look at the blue line. Next, take a look at this chart.